So, hi everyone, welcome to another episode of our webinar. We switched things up a little bit this time. This is an investment webinar. So this is also going to be educational, as many people are not used to oil and gas industry as much as they are with real estate. So say there's over 100 ways to make money in real estate itself. Then we pride ourselves, Dr. BDZ Capital, as a real assets company. So we do oil and gas, and George, my partner, does some mineral rights in the past, agriculture, and then we also do businesses. We just don't focus just on real estate. So that is what distinguishes us from other real syndicators, is because we are more diversified. So it just depends on how you take a look at it. You can say too much diversification. There's all this argument here and there about it. But we believe so that if one asset class is not doing well, you're more likely to do well on the other asset class. So you can be have a more balanced portfolio. A little bit about myself. I'm a physician. I'm a pulmonary critical care doctor in Fort Smith, Arkansas. I own my own private practice now, and that's due to ability to create some passive income over the past 6 years, working as a pulmonary critical care physician. I've been in the real estate and real asset industry for over 10 years, and we have over $164 million asset under management between properties and deals that we're operating, and also we co-partner with. And this cut across multifamily, self-storages, offices, luxury senior living. We just exited those two. We do also done at least 2 funds in oil and gas together with King Operating. We partner with them as an affiliate on this particular one. I invested with King Operating in 2022 as my first time. And before that, my mentor, Gaurav, has been invested with them for many years before, and he's been giving me good report about them. So then since that time, I've been investing with them. And with oil and gas, we do have the ups and downs, but I would say that I've had a very good experience. We're going to talk about those as we go, interject as Brad talks. The most important thing for me was the tax advantage. When I put in my 100K, I got 90. It was one of those years where I got like the first year was like 95,000 or something like that back in depreciation. And I was still working, figuring out some of my real estate professional. My wife is a rep. She's reps, but she's also a nurse. So at some point she was working as a nurse a little bit, but now she's obviously a full-time stay-at-home mom. So if you are not a real estate professional, you're going to have trouble taking advantage of the tax benefit from real estate immediately. But with oil and gas, that is not the case. So you can use it to offset. I'm probably say, I don't want to say all, almost all type of income. So without further ado, I'm going to just introduce Brad. Brad is a senior vice president and is my contact with King. And he's a dynamic leader with extensive experience in strategic operations and business development. He plays a key role in driving growth, fostering client relationships, and overseeing critical projects. And I'm a testament of that. We've been talking for about 2-3 years now, and he's very responsive. Like I text him, responds. I ask for proof, he sends it to me. I ask for more information. I want to talk to his tax guy because sometimes it gets confusing in the beginning about the tax benefits. And the CPA, some CPA were having trouble figuring out how to deduct from the K1, and he would get the CPA on board, and then we'll get a Zoom and group text, group meetings, and figure it out. I love the team, but I'll let him talk himself. Okay, Brad?
Excellent. Dr. Breezy, thank you again. Appreciate you guys taking your time to learn about our opportunity. What I'm going to do is I'm going to run through this KOP 111. That means COP 3. This is our third fund in the past, let's see, it's 4 years now. And basically, we are drilling American oil and American soil, and obviously looking for a multiple at the end. And I'll get into that. So let's just dig in. Now, this is our disclosure. Any investment you do has risk. This is from our attorneys. We have to put this in. You'll get a copy of the slide deck and you can review this at your leisure. So let's get into the program. So basically, what is it that we are talking about? Well, what we are doing is we're raising $100 million fund that's tax advantage, income producing, and asset secured that we plan to sell within 3 to 5 years. And our projected multiple will be a 2.3x on invested capital. And the 2 points below is our risk mitigation for our opportunity. So not only do we drill our own wells, but we also drill wells through partnerships. The reason why we do that, it allows us to spread out our dollar, and instead of drilling one well, we can drill two. We also, for instance, in our last fund, we picked up proven production from Conoco, a couple of Conoco wells, and this all just helps take the risk down of the investment. So why King? Why us? There's lots of other oil and gas companies. Why us? Well, the first 3 points right here, I'm going to go over in detail throughout the presentation, but I want us to focus on our business model, which is basically, it mirrors real estate. Like when you pick up a pre-owned home, fix it up and flip it. We do the same thing in oil and gas. So we acquire mineral leases, we develop them by drilling wells, and then once the value's high enough, we sell it for a multiple. Now, other oil and gas companies obviously acquire and developed, but we have still yet to find one that allows you, the partner, to basically participate when we sell it. So normally in oil and gas companies, you're investing in one well and it's producing or it doesn't produce, and then that's it. That's all you get. But what we do is once we have increased the value, we sell it for a multiple. Everyone asks, how do we do that? This kind of gives you a very simple illustration to the right. So imagine this line in the middle that's called a PDP. It's called a proven developed producing well. This is one well that we would drill. And for this example, let's say this well costs $10 million to drill. What that does is on each side of the well, it creates PUDs. These are called proven undeveloped. And so banks, other oil and gas companies, they value these wells at about half of what you've drilled this well. So just by drilling the well, and it basically increases the value of the asset by 20 million. So that's our main goal. And basically drill wells, get good production, create PUDs, and then allow another oil and gas company or whoever the next buyer is to come in, and they're going to be drilling the PUDs because they know that it's proven. So next slide here. All right, so let's talk about our drilling projects. Where are we drilling? When our geologists and engineers, when we open a fund just like this, we have to make sure we have a minimum of 5 locations. They're all in Texas. We have basically started on 1, 2, 3, 4 of them. And then what's going to happen is we're going to see where we're at, how successful, economical the wells are, and then we can jump over here into Rocket Ranch, which is another big project. So I'd like to talk a little bit about each asset. So just a little background on the Bivens Ranch. The owner of this back in the 20s and 30s was named Lee Bivens. He was actually the largest cattle owner in the world, 60,000 head of cattle at one time. It was pretty crazy. But in 1991, he had an oil and gas guy come in. They struck oil. They struck a lot of natural gas. And actually, there's a city right here called Amarillo. It actually used all of its natural gas from this field. The 5 reasons why we are so excited about this opportunity starts with the geology. So our geologist, this right here is a mud log. So Basically, what happens is we spend over $1 million on it's called 3D seismic, and it shoots these waves down in the ground, and the waves come back up, and it gives our operations team an idea of where in the earth the oil is, where in the earth porosity, pressures are. So number one, if you'll see these two brown spots down here, this is oil. And so the fact that, and again, I know you really can't see the numbers, but this right here is a total of 600 feet of pay zone. And what does that mean? Well, that means when we go down, we don't just drill vertical wells, we drill horizontal. And the reason why the new technology, along with fracking, allows us to go into the middle of all the oil. So basically, we'd be drilling down, we'd go straight into this, and would just be completely surrounded by oil. And the fact that it's 600 feet of it is great, because normally it's around 20 to 30. And it's hard when it's human controlled by a joystick. So it's hard to make sure you stay in zone. But the fact that it's 600 feet, we're really excited about that because we can stay in zone and get the most oil out of the ground. Number two, back to this slide, in the Bivens Ranch, we're going to be drilling the PUDs from other wells that were already drilled. So we're not going in and this isn't exploratory. This is more of a development project where we know the oil's there. We just got to drill these PUDs to make sure we're going to be getting it out. Number three, our geologists have said that there is 5 elements in here. And normally we drill wells when there's 2 or 3, we're excited about that. This one has all of the elements needed to drill a well that's economical. So they're excited about that as well. Our main geologist and our main landman, before they came here, they worked for a larger company that drilled in the Bakken, which is another big shale play up in North Dakota. And they are basically telling us this is a Bakken lookalike. And why does that matter? Well, they drilled it for 15 years and they feel very confident on what to do, what not to do. So the fact that it looks like the Bakken mud logs, that's another plus. And then lastly, when the wells were drilled out here in the first, they were only using generation 2 technology of fracking. As of today, we're at generation 5. And what that basically means is it's going to put, once you drill the well, you go in and put a plug in it. And then basically it's like fireworks or gunshots that basically go into the wellhead and basically open up the well. So the majority of the oil and gas seeps in. So Bivens Ranch, that is our number 1 priority right now. We have 2 wells that are actually staked. So we plan to have those start drilling by the end of this month. If we go over to Vesuvius, this is one of our projects that we have another company called Rise Energy who's drilling it. We're basically going in 50-50 with them. They have been very successful in this field already. So we feel very confident that they're going to produce and it's going to be nice, obviously, from their previous wells that they've drilled. We've already drilled one of them. The first one, it's called Constellation 2H. It's drilled, it's waiting on completion. We're waiting for the next one to finish. And the next one, we're actually 3/4 of the way down. It's about 10,000 feet down. And then we go 5,000 feet to the side. So those 2 wells are waiting on completion. Those should be online at the end of this month or possibly the 1st of January. Over here in Fisher County, we actually have 3 wells. One of them actually is already producing. We have a little smaller interest in it. We're getting about 20 barrels a day from this one. And again, we just opened the fund on the 15th and we already have oil. So we're really excited about that, number 1. But also, there's another well called the Jack Straw that has been drilled also, and it's waiting completion. And we're waiting for the next well, which is called the Tennessee Jed, to be completed. Then we're going to frack both of those at the same time. It saves money and it just makes sense for Fisher County. Now, lastly, in Giddings, basically we went in here in our previous fund and we have 1 well that's in the previous fund. It was so good, we actually feel confident to drill 2 more. We're going to be drilling 2 more of those by probably the end of December and January. We have 2 wells up here. 3, 4, 5, 6, 7, 8, 9. So we already have 9 wells that are basically in different stages, but they're already being drilled and they're already, which is going to obviously allow the production to begin. And we're anticipating the first distribution we do distributions monthly, and we're forecasting probably around the end of the first quarter for the first monthly distribution. It'll be a little smaller, but again, as more wells come online, it'll continue to pick up. So that's the overview on the assets. Now, the investment itself achieves value in 3 ways. The first one is it is 100% tax deduction. So basically, by making the investment, if you invested a unit, basically you're reducing your tax burden around $60,000, which I'll get into more detail on the next slide. Monthly distributions, we're targeting 9 to 14%. Again, it's going to probably take about 3-4 months to get up to this 9, but it all depends on the price of oil and the price of gas and and the amount of production we're getting out of the ground. So even these numbers right here are based off of $65 oil, which is great because today it's hovering around $70. We feel pretty confident we can get to this 9 to 14 probably towards the third quarter of this year. So on top of the tax burden though, and on top of the monthly distributions, we have the exit. So our plan is for someone, for instance, if they invested $200,000, which is 1 unit, within 3 to 5 years, we'll show them a $460K return on their money, which again is on top of the monthly distributions and the tax write-off. Okay. All right. This illustration explains how the tax write-off works. So for instance, we're basing this deduction factor right here. We tell people it usually can be between 75 and 85% for the first year. So for this illustration, we're just going to use the conservative 75% number. So if you were to invest $200,000, basically next year, you're going to get a K1 for a loss for $150,000 in March. And if you're in the 40% tax bracket, just by making the investment, you save $60,000 on your money. The balance of that, so the balance to make it 100%, that extra 25%, that can be taken off of when we sell the asset. Basically, that extra 25% will be used as a deduction on your capital gains when we exit. Okay, picture this as $1 of oil. People want to know when the dollar comes out of the ground, where does it go? So first it goes to the royalty owners. We lease the mineral acreage. So probably around 24-25% will go to the royalty owner. Then lease operating expenses, everything that's drilled in the field, the wells, maintaining them, basically the day-to-day operations. Then we have to take care of the bills and everything. So after royalties paid and LOEs are paid, the rest of the money, it's an 80-20 split. So 80% to the partners and 20% to us, King. Now, once you have gotten a return of your investment, this changes to 60% and 40%. 60% to the partners, 40% to King. For December and kicking off our fund, they're actually allowing partners to have an incentive instead of this 60 to be 70. So that's actually really a big deal. And let me explain why. So once you get your money back through monthly distributions, small divestitures, things like that, this right here is where all the money is made in oil and gas, and this is on the exit. If you factor in 10% more, it doesn't sound like a lot, but it is a whole lot of difference on your investment on whatever number that you invested with us. So that's great for people that want to take advantage of, number one, your tax advantages for 2024, but also get an extra 10% on the back end. This is called the back end.
Okay. Brad, can you explain what divestiture is to
Okay, yeah,
this.
absolutely. Divestiture is the same thing as selling. So basically, and I will get into that actually on this slide right here. A lot of people, when we drill the wells, increase the value of the land, that's obviously when the time's right, we sell it. And people always ask, who are you going to sell this to? Sounds great, but who's going to come in and buy this and have enough money to do it? Well, we've been approached by institutions, family offices, pensions, people that actually are out there mandated to look for producing income, or it's going to be another producer that's in the area that can easily access the property and they have the ability to drill the PUDs that I was talking about, which are these two right here. So it's going to be either income buyer or a producer. Does that make sense, Dr. Bio?
Yes.
Okay.
The way I got it was in the first fund, you guys sold a small portion
Correct.
of the whole fund and then distributed the money to us.
Yeah. So basically, what happens sometimes, like for instance, in that fund, one of our assets, we got it to let's just say, I don't know, let's take Giddings, for example. On this asset, let's just say in the last fund, we got it up to a price that made sense. And we actually had a buyer come and buy it. They might buy the whole asset. They might buy just 200 acres. It just depends. So those are the little things that help you get your money back. Number one, your return of investment, but it also obviously helps your investment because you're making a multiple on a smaller portion of it immediately. So, make sense?
Yep.
Okay. This is actually my favorite slide in the entire project. It's our cash flow analysis. So what I love about it is it shows you the worst case scenario and the best case scenario. Now, our break-even price for our deal is in the 30s. Even if oil went down to 40, knock on wood, we're still showing a 1.6x on your investment. Now, obviously, if it goes up to 100, that's where we're targeting the 2.3. As of today, we're right in the middle of the 60 and 80. So it's right around the 2x. And again, this is if oil stays at 70 at the time we sell. If it's higher when the time we sell, the multiple will be higher. If it's lower, the multiple will be lower. But it just depends on oil prices and the amount of production we're getting out of the ground. Okay? Now, this is a key metric basically on our monthly distributions. From 2021 to 2023, we've had our average annualized distribution of 8.8%. That was every month cumulative, it came up to 8.8%. Our last three distributions on our previous fund, which Dr. Bio was mentioning, in September, it was 6.9%. In October, it was 8.6%. In November, it was 6.4. And again, that fluctuates with the price of oil and the amount of production we're getting out of the ground. But it just gives you an idea of our past on our monthly distributions and basically how it works. Now, this kind of goes to our tax deductions, a track record for it. On average, since we've been in business since 1997, we have averaged around 82% for the first year write-off. Now, from 21 to 23, as the years have gone on, we've gotten a lot better on it with the intangible drilling cost, which basically helps raise that percentage higher on your investment. So we've averaged around 85.4%. And to make that simple numbers, if you invested 100 grand, on average, you'd get $85,400 as a loss on your K1 that you can write off on your taxes. If you can see right here, 21, we did 80.84, 22, 86, and 2021, 86, and 2022, 87. So it really helps people that have a tax issue instead of paying the IRS, getting this write-off and being in an investment that can show you a multiple at the end. Now, I've talked about the deal. Obviously, you've seen me on the screen, but You need to know who you're dealing with. Our CEO is Jay Young. He's a fourth generation oil and gas guy. We've got around 200 years of industry experience with all of the employees here. We're in an office building in North Dallas off the toll road, if you're familiar. We're on the 9th floor. We've been in business again since 96. And our mission here is to help partners achieve significant tax savings, monthly distributions, and a multiple on their invested capital. So here's Jay. He wrote the upside of oil and gas investing. It's a #1 selling book on Amazon. Highly recommend it. He basically just talks about our business model, why it makes sense, and why it is the absolute best way to invest in oil and gas. The three on the right are all our chief officers. Jimmy Cleveland, they've all been involved in private equity in the past. Steve Mulliken and Brian Dutton, they actually come from oil and gas companies that actually have sold an asset before they came here. So we're very happy that we have their guidance in what to do and what not to do. And to follow that up, our operations team, Bill Phillips, Kelly Duncan, Paul Jerome, again, these two have actually been at a company before that were involved in two different asset sales. One of them was for 800 million and the other was for 1.2 billion. So from an operations standpoint, we also have background on what to do to make our opportunities. Rex Gifford is the one that Dr. Bio was talking about. Used to work for the IRS. If any of our partners or their CPAs have questions about the K1 and how the write-off works, again, he's willing to get on the phone, talk to anyone at any time of the day, which is great. And then Eric Rice and John Malden's been around forever. They're basically our economists. With everything going on in the world, we love getting their input on when to buy things, what not to do, what to do. So it's really good to have those two on our team. And then lastly, if this is something that you like, if it is something that makes sense to you, it's how does it work? How do you take a position? Basically, what happens is you review the PPM, and I'll send a DocuSign with the subscription agreement. Wire the funds, provide us a third-party accreditation letter from your attorney, financial advisor, or you can just send us the first 2 pages of your past tax 1040s that show you made over 200,000. The reason why we do this is CE wants us to make sure everyone that invests in this is accredited. So that means you made 200,000 or more for the past 2 years, or with your wife 300,000 or more, or you have $1 million in net worth. After that happens, you're in. You'll have access to the portal within 30 days. It shows your positions, your monthly statements and K1s. And then most importantly, I think, is the updates. Every week we do a 2-minute drill. It comes from one of our executives. We talk about what's going on in the field and what we plan to do in the future on the fund. So it gives you a weekly update if you want to, for only 2 minutes, on where we're at on your investment. We also have a monthly newsletter, and we actually also do monthly updates from the executive team. They all get together and they do a probably 15, 20, 30-minute basically overview of where we're at, where we're going, and what we plan to do. So that is the presentation. I'll go ahead and open it up to questions. Dr. Bio?
Okay, thanks, Brad.
Yeah.
I'm sure people have a lot of questions, but there are a few to get started. And of course, it's always the tax questions.
Sure.
The first one says, are the distributions taxable?
Are the distributions taxable? Yes, they are.
Okay. Can you explain a little bit more? I know you're not a CPA, but
yeah, basically they're considered as income and they will be considered taxed. So
if you have any inputs, that was our planner, tax planner.
yeah,
But the thing is, when you get a K1, almost always, I guess if you invest every single year, then it would be like a negative, right? The first one you get it would be negative anyways. is the distribution already not accounted into that, into the K1?
Yeah, correct. It'll basically show you made X amount of money, and
Mhm.
then on top of that, it'll show the negative part, which is the loss.
Yeah.
Oh, go ahead.
So yeah, so let me chime in a little bit there. So the way it's reported is that it's going to show on a different column on the K1 as distribution, and then you're also going to have the negative losses on another column. So it's going to eventually offset each other. So it's going to eventually offset each other. So you shouldn't really see the effect of the distribution as much, because the losses and the expenses and the depletion expenses will outweigh the distribution.
But that is on the
That makes
first year, right? What about the subsequent years?
Yeah, no, and yeah, in the subsequent years, basically, in Taiwu, hey, correct me if I'm wrong, but that is taxable income, and you will receive a K1, obviously showing that you made that money. Is that right, Taiwu?
Yes. So in year 2 and year 3, because you wouldn't have that huge loss coming in, so you might be having a positive distribution number, and so eventually that's going to be taxed in year 2 and 3. Does that make sense?
Yeah.
Yes, and that's why I
Yeah.
do it every year.
Is-
Because you're basically trapped, not trapped in a good way. So once you do one, you basically just continue to offset it. So
Yeah.
now you just
Yeah.
continue to push it forever.
Makes sense.
Yeah, it's just like when you compare it to real estate as well. In year 1, you're doing your cost segregation, getting the huge distribution, the huge depreciation expense. Now, when you get to year 2, you don't get that huge depreciation expense. So you're probably having a positive cash flow that's been taxed. So the same analogy applies to this as well.
Is this an active, would it be considered an active income or a passive income? The cash on cash distribution, monthly cash on cash.
Taiwu, what's your answer? I'm quizzing you. I'm quizzing you.
Yeah, from the ones that we've done, for some of the clients that we've done this for, this is more like an active. For the year 1, this investment is active. And that's why you're able to offset the losses against any form of income,
Correct.
any form of non-passive income as well. Yeah.
That is right.
Okay.
Thanks. I'm sorry to put you on the spot, Taiwo.
Yeah, thanks, Taiwu. I appreciate it.
I mean, she's always
Welcome.
ready to help them.
So I have a question. When you finally divest, you're talking about 2 years time period for divestiture?
Yeah, that's a great question. Say 3 to 5 years. With this fund, like our last fund was 200 million. I would say this is very conservative on a year. I would say that since this fund is $100 million, we would probably be able to get all the work done within the first 1.5 years, and probably in the second year, we'd put it with our brokers and get it sold. Don't hold me to it, but I feel pretty confident we can put it on the market in 2 years.
And then what about the taxability? You're going to get taxed on the profits minus the basis. And is the basis the reduced basis after the expenditures?
Yes, that is correct. That is correct.
I didn't get that. Is there like depreciation recapture?
Yes.
Yes.
Yes, there is.
There is.
Okay.
Okay, so that's it. And we also have a video on YouTube from we had 2 webinars on our YouTube channel that you can watch of the first fund, which is similar. And also we actually brought the CPA from King on and the economist, both of them battled it out on the taxes and how it works and the depreciation. They use actual numbers. So that 1-hour video also. And so the next question talks about how do you expect the energy sector to change based on the new political climate? Do you plan to sell your drill sites in the next 4 years? Which is funny because that's what we were talking about before we
Oh,
did
yeah.
that.
No, and again, I get that question daily. Obviously, with Trump and his drill baby drill, a lot of people think, that's just going to make all these oil and gas companies go out and drill. But the problem with that is the rig availability. Right now, it's hard to get a rig. And even if you can't make rigs in 2 months. And on top of that, rigs cost about $25 million. So it might increase it a little bit. But again, with everything that's happening in the world of the Ukraine and obviously with Trump, if he, if he makes Iran mad still, that could skyrocket the price of oil. We are anticipating, and what we've heard from Trump getting into office, basically it's going to stay steady where it's at right now. But with him raising tariffs and things like that could only help us increase on the price of oil. And if that's the case and it's economical, we could definitely sell within 4 years.
Hi, my name is Chris here. My question is a limit to the deductibility of the capital that you invest. Let me explain that quickly with an example.
Okay.
Rental property, and I was given the impression that if I was a good active manager, all my expenses are deductible, only for me to realize because I make more than $150,000 per annum, that expenditure could not be deductible. Does similar thing apply here? If I make more than $1 million and I invested $100 grand or $200 grand, with my income limits how much I can deduct, or what I would qualify for that deduction or not? Thank you.
Yeah, no, that's a great question. No, it does not at all. Are you about to talk?
No, so it does not affect the deductibility. It's different from the real estate 150 threshold that you mentioned. This does not affect the deductibility of your expenses, of your investment, if that's what you're asking. So for example, if you invested $100,000 in year one, you're able to take the tax write-off in year one without the limitation that you typically face with real estate investment if you're not a reps as a real estate investor.
Correct.
How many deals have you guys successfully divested?
Sure. Great question. So this is our third fund. We just closed our second. We plan on our second to put that on the market in the middle of next year with our brokers, because we have a couple wells that we're going to be putting online in that. But our first project, it was a lot smaller. It was a $6 million raise, and we were able in only 18 months to drill a couple wells, and we basically returned a 3x on our client's money. We've only done it one time. That was only a $6 million raise. So this one being $100 million, it's in the middle of our small one and then our big one we just did. So we feel pretty good. That's a sweet spot for us. And we feel like we can get this one done obviously quicker, just because it's not as much as the 200 million and it's not as little as the 6 million, and still achieve, at least a 2-to-1 on your money.
Okay, how many years have you guys been in business?
1996. We started this business model in 2015, though. So our first project was in 2015. It was a lot slower. We raised the 6 million, and with only 18 months, we were able to sell it. It let us, COVID happened, and then that's when we opened up our second fund. And then as of today, this is when we're here on our third fund. Good question.
Yep. So there's a question of minimum investment.
Sure.
I know in the past it used to be like a full, you have to buy a whole unit, but I think there's more options.
Yeah. So right now, just being December, that's when we get pretty much every partner that we had in the past come to us because they want the tax write-off for 2024, and everyone puts it off till the end. They have opened it up. Instead of basically a minimum being 200,000, the minimum right now is 100,000. So if it is something you're interested in, our minimum is 100.
Any more questions?
Is that set on stone, or do you guys accept 50?
Like case by case basis.
I hear this again. I hear this a lot as well, Chukwuka. So what I will do is I will go to bosses tomorrow and just ask and say, hey, on our webinar last night with Dr. Breathe Easy, We were asked about 50,000. We'll see what they say, and I'll let Dr. Breezy know.
So the minimum is 100,000. If you want to go a bit higher, how do you do that? Can I invest say 102,000, or it's gonna go by multiples of 10 or multiples of 5, or it doesn't matter?
Yeah, if it's 100, you can invest anything over 100 in 25,000. We just had a guy invest 1.5. When it gets over the 1 million, they really want to feel comfortable who you are. You can invest up 25,000. So 100, 125, 150, 175, 200. Just basically what works for your comfortability and what can help you, obviously, with taxes is what I would recommend.
So what I heard you say is, so the increment can only be in multiples of 25,000. So you can do 100 on 125, 150, 175, or can
Yes.
I go anywhere in between any of those numbers I mentioned?
I'm sorry, what was that last part?
So I'm going to
No.
just cut it. So if you, let's say I have 110, can I do 110?
Yeah.
Or even 107 or 108.
It's a very interesting question, Therese.
Well, here's the thing. I'm pretty sure my boss will say yes to it. So if you want to do 107, 108, we could definitely probably make
One
that.
at 3.5.
Yeah.
50 cents.
Let's not get into cents though, please.
It's just more easy, even just for real estate too. That's why we always put like those 25s. It's more easy for accounting purpose and also to do your distribution because it's odd weird number is going to be decimal points.
Yeah.
Help from me. Is there a deadline? I know December 31st is not really the deadline. What is the time expectation? So if I declare interest, say on December 15th, what are the chances of getting everything concluded within a 2-week period? In other words, what's the open and close period for someone who's interested?
Yeah, no, that's a good question. So once we hit that $100 million mark, that's when the fund's closed. To receive the incentive, you have to get it in by December 31st. We don't anticipate closing out the 100 million just because we have 10.8 million right now. But we're probably gonna, I would say we would get to that 100 million probably by March or April of next year. That's just giving you a time frame of how we have 48 employees, and we also have another 10 people that work here as a vice president that does webinars like this, talks to people, talks to family offices. That just gives you a good idea.
Yeah, and also based on the last ones. The reason why I did it, I really was not planning on doing anything else this year. I was tapped out after closing those two large properties that we did. So I wanted to rest, but I figured it's December and people might want to take that tax advantage before the end of the year because I do. That is correct. I normally don't do this until I talk to my tax planner and then usually tell me, look, it looks like depreciation, you took a lot of millions last time, so it's slowing down. So you need to do more. So then I will rush quickly to try to do some oil and gas and any other ways to get that depreciation. So December, that's why it always comes down to doing it in December.
Now,
Dr. Bayo,
Yeah, go
the
ahead.
question for you, what has your experience been so far, like cash on cash and others? Tell us your experience.
So I started in the beginning of 2022. I think it's the January or so. So my experience has been all over the place, but like you said, the average has been close to 10% for me. So in the beginning, it was in 2022. Actually, I think that first year was like 20%. Correct me if I was wrong, Brad. I remember. I just remember just rolling. I feel like I was rolling in the money. Between when I had that, then I had the depreciation too. And I thought it was more than 80 something. I thought it was 90. It was a lot. Anyways, so that year, I felt between those depreciation, which my tax bracket at that time during COVID for critical care was very good. It came in handy. So that's what it is. But I think later last year was a rough period. for that fund where it was very low. There's always distribution, but it was very low. So I think, what did we end the last year with, Brad? Percentage-wise.
What, this year or last year, we averaged 8.8%.
I thought it was less, but when you combine I do know for me, because I had that 20 first,
Yeah.
when you combine all the other ones, my average was pretty good. Probably, beat the real estate, because some of the real estate will stop distribution, right? In between, some of them takes about 6 months to give you your first distribution. Some takes a year, some no distribution at all to the end. So, but with oil and gas, I was always getting something. So I felt, and also, so that's my experience. And the communication also been great. And so every year I get my depreciation, and then there's always some change. And for me, I'm still looking forward to the exits. So that's one thing I would say that is missing on my side, the exit. But my partner has been with them for longer. So that's it. That's my experience. I'll say my experience is very favorable. There are some people that came in when everything was low, just like anything else. If you buy the stock at the top and then you buy at the bottom, but if both all of you leave the stock alone, over a period of time would make profit, right? That's it. So I'll say just prepare your mind that it is it's not like real estate, which is very stable, complete. And the real estate is not really that stable as much, stable, but just because we have the preferred return is what makes it stable for investor, right? Because we will hold getting anything, and then the investor will get the distributions, right? Until the end. So that's what it is with that. But with oil, because it's by the price of oil, so one time the price of oil was like 100, 105. So we were getting such a lot of distribution. When the price of oil is like 70 or 65, then your distribution is less. So just know that it's not going to be consistent in terms of the same amount, like you get 2% every quarter or something like that. And there's one time where we had a divestiture also, like I said, that I suddenly got thousands of dollars all at once, in my bank account. So that's what it is. So just know that, look at your average, just don't look at month to month, because you might get 2,000 one month, the other month will be like 500.
Yeah.
And the next one will be 3,000. And then next one will be like 300.
So,
yeah.
Yeah, but I didn't mean to interrupt you because I just have barely 1 more minute to get off. I'm starting work in a few minutes. But I want to ask last question. Trust me, the last for me anyway. The investment, so to speak, is tax deductible, which will most likely generate a negative. Now, these negatives that they generate, would it apply to offset every other income, or does it only apply to certain classes of income?
Yeah.
Because again, I use my real estate as an example. I think this question may go more to the CPA. If I do my 2024 tax by next year, and I have a negative of say 90 grand, and when I do my 2026 and I have positive from other sources, would this 90 grand apply to everything else, or are there some restrictions to where you can apply that negative or no?
Basically, whatever year you invest under the IRS tax code, that's the year you can write it off, number one. So if you invest in 2024, it basically, the K1 will show basically the loss for 2024. Now,
yeah, but you roll over negative. So if you roll it over to the next year, would it apply to other positives, or can only use it for that year and for a certain class of incomes?
Yeah, I mean, from an income standpoint, from what I've known being here over 8.5 years, it basically is, you can take it off of active or passive income, basically any income that you've made in 2024.
Yes. And depreciation
No.
they're
So let me
carried
just
forward.
check it. Yeah. You roll it over, carry it forward to the subsequent years, right? So I do my 2024 and I get a negative of say 90 grand. My assumption is to carry forward to 2026 25 and 26. And I just want to be sure whether there's any restriction to where the negatives can be applied or only applied to similar investments. For instance, I was given the impression that you can only offset certain rental income with rental. I mean, if you have in your rental business, you can only use it to offset positives in the long run in subsequent years, only for such similar passive rental incomes. Does that apply same here in this kind of fund or investment?
Probably give it to, if Taiwo is okay, give it a disclaimer and answer, or we can get you the tax guy. You know.
Yeah, so what I would say to that is that if you have an unutilized loss, so I'm assuming your question is if you have a loss in a year that you're not able to fully utilize and you carry it forward to the subsequent years, are you able to still use it to offset any type of income? So this type of losses we are discussing here are losses that can typically be offset by any income, any non-passive income. So you are comparing it with real estate. Real estate is passive. Yes. So, sorry. I'm so sorry. My daughter is here. So real estate is passive, but this one is non-passive. So even if you have unused losses that carry forward to subsequent years, you're able to still utilize those losses to offset your future losses. Now, I also want to mention that typically for the ones that I have seen, in year one, you should be able, if you have enough income, as most physicians have enough income, you should be able to fully utilize your loss to the extent that you shouldn't have carry forward losses. If you're just talking about this investment alone, not considering other investments that you have. Does that make sense?
Yeah.
Yes, it does. What I'm understanding is you can only use, in my case, I'm going to run a negative come 2024 anyway. So if I invest this, I'm not going to use up all the deductions. So I will carry it over. But what I understood from your response, Tayo, is this can only be used to offset. Whatever loss you get here can only be used to offset active income and may not be used to offset passive income. Is that correct?
Both. You can use it to offset both passive and non-passive. Both passive and non-passive.
In the long run, after this first year and second year, right?
Yes, in the long run, yes.
Correct.
And also another thing is, it's another factor you have to consider is that, so I'm saying this based on the ones that I have seen, based on some of our clients that have used the strategy, is that what they typically do is that in the first year, they let you invest as a general partner. So as a result, your losses in the first year is non-passive because you're investing as a general partner. So the losses you're getting is going to be non-passive. So you can use it to offset any loss. Now, when it gets to year 2, year 3, and year 4, your deductibility of those losses is dependent upon whether you're switched from being a general partner to a limited partner. And I know that we discussed this last year, but I don't know if you remember when we spoke with the last webinar we had last year about oil and gas. And this was the same thing that he said. He said that for the first year, you're going to be investing as a general partner, so you're able to utilize your losses. And then subsequently, the second, third year, you can switch to being a limited partner, and then it becomes passive. But when you have unused losses in year 1 that you're carrying over, the nature of that loss is non-passive. So when you carry non-passive losses to subsequent years, you're able to offset it with other non-passive income and other passive income as well.
So basically, active loss is superior. You can use it for any. I can use it.
It's okay.
Okay. Thanks so much. Good clarity. I love that. Thank you.
There's another question, and then we can close. The intangible drilling write down Apple's next year's taxes. Can you explain more, Dr. Stam?
Yeah, I've done this in other companies, and the write down usually happens the next year. But from what I was hearing from what you guys are saying, that actually happens, you get to take the write down in the year that you invest. You invest this month, you would get the 75%, 80, whatever it is, write down intangible drilling costs. That write down on your K1 for the 2024 taxes or 2025?
2024. The year the investment is made is when you can use the tax write-off.
Yeah.
Okay. So Adebayo, you can get your money in at last minute and get your write down this year then.
Yeah, you
It's
already know that's
crazy,
why I
but
do it in
yes.
December.
That's right.
I do in December for that reason. Back in my head, I was like, you know what? I can put everything off, and then oil and gas, I do it in December. So that's that's what it is. Because as long as your money, I don't play with fate and wait for the 25th. I always imagine the year is ended by the 20th. So I try to aim for the middle of the month.
I have one more comment. Brad, you seem pretty bullish on the price of oil just from straight supply and demand things. And obviously you mentioned some other things with Iran and whatnot. I think one of the first things that happened when Biden came into office is he shut down, and correct me if I'm wrong, he shut down drilling on public lands, and that automatically decreased the supply of oil.
Yep.
Which raised the price of oil due to supply and demand, plain economic curves. It
Sure.
seems to me that if Trump is going to open back up public lands again, that might increase your supply of oil, and in a controversial, in a contrary way, drop the price of oil. And I think the price of oil, completely aside, I think the price of oil was probably the reason why the inflation got started in the first place. That's my personal opinion. And it seems in order to be able to maybe reverse some of those negative effects, that increasing the drilling would increase our supply and therefore decrease the cost. So I'm a little bit less hopeful than you are. It sounds like that the price of oil is going to stay up. But again,
Yeah.
just
No,
that's my thoughts.
Yeah, no, you make complete sense. Again, it goes back to number one, rig availability, because even if 10 companies want to go drill wells, they don't have the ability to lease the rig and drill it. And then on top of that, we're anticipating, obviously, with Trump to open up the LNG ports that were closed down. And once that happens, we're going to be able to sell natural gas for a much higher price. And we're anticipating natural gas prices, because they took a huge drop, 70% drop. Once that opens up, that's going to slowly start trickling up the natural gas prices. And obviously, that's actually going to help the oil and gas industry.
Is some of the separate question, is some of what you're drilling going to be gas as well as the
Yeah.
oil?
Yeah, we try to keep it between 50-50 oil and gas right now. With that 50-50 is 80% is oil and 20% is natural gas, just because nat gas prices are so low. Once those come back up, we'll focus more on natural gas prices just to help mitigate the risk and make it as economical as possible.
It'd be a nice buffer. Okay, that's a good point.
Just I know we're done, but Brad, I think there's something happened with one of the funds in which you always strike water before.
Correct.
And then you have to evacuate it, and then one time you were able to make a deal with the water, also make some money off it.
Correct. Yeah, basically that opportunity in Colorado, we had a water treatment plant, and we basically are, and again, that's still in fund too. We're talking with the municipalities around it, the developers, because all of them are coming to us saying, hey, we need you to drill a couple wells. And that water treatment plant could probably be around 20 to 25 million if we get those contracts set up and sold. That's just another odd thing, that we're selling water, and it could be a multiple on the investment. So that's true.
Yeah, good stuff. Okay, so you guys can reach out to Brad directly. You can reach out to me. You always know, if you're on our WhatsApp chat, you can just ask questions, text me directly. I'll tell you my opinion. I'm open about it. That one of the most important things with oil and gas is you want a reputable company. That was the most important part. And John knows we come from a country where the oil and gas, you have to do your due diligence. You literally have to go see the rig. And George actually went to take a look, and many members of our team went there. I haven't actually been there, but people have been to their offices multiple times. And so we know they're real. We've been with them for many years, and we've known them even further, longer than that. So That's the most important part. One for me, that when you do all this oil and gas, everybody promise 10x, but only if you have the money, if you can see your money, in the first instance, is when you're going to get any return.
That's
So
right.
it's better to take it conservative, start with who you know and a team that is reputable, and then, and then you can go from there. Okay.
And one more thing, I put my email and my number in the chat if you want to reach out to me via email, if you want me to send you the book, if you have any additional questions, this is what I do all day. Or go ahead and you can email Dr. Bio and he can get with me and we can answer questions. I can send DocuSigns, you name it. Again, thank you for joining us here just to learn about it. Anything else, Dr. Bio?
No, I think we're good. We're going to piggyback on the ones that we've done before. And thanks for coming, as always. And maybe we'll bring our Eric Price back for economic discussion someday.
Sure, absolutely.
Okay. Thanks, everyone. Thanks for coming. If you have any more questions, please reach out. Okay. Take care, everyone.
Have a good night.
Bye.
Bye.
Hey, guys.